What's up everybody, my name is Wes DeVore, and on this channel we talk about long-term investing over the course of 5 years or more, building surefire wealth and personal finance. Be sure to subscribe and smash the like button, leave a comment down below for more content like this. In this video I want to talk about some major overarching facts that have a serious impact over whether or not an investment will be profitable or not. Without understanding these essential statistics about market behavior, you're basically at a loss. The concepts discussed in this video are what you should always consider before you make a decision to buy, sell, or hold a stock. Alright everyone, so this video and channel are for entertainment purposes only. I'm not a financial advisor. I just am interested in personal finance and the stock market. Your investments are your own decision. For professional guidance, be sure to consult with a certified financial advisor or an accountant. Now, the very first point is that when you're investing in the stock market, you can and you probably will lose money at some point. A lot of people on the internet forget about this, and as soon as they lose money, it's chaos, chaos, chaos. But if you are invested in companies with strong balance sheets and healthy cash flow, patience will pay in the long run. And remember, if you don't have time to do the proper research on individual companies that you may be interested in, you can always dollar cost average index funds and staple companies like Amazon, Facebook, Google, Netflix, and over the long term, you should do the average market return. Now that aside, I want to drill home the point that if you are not prepared to lose a little bit of money temporarily, then investing in the stock market is not a good idea. The reason is because obviously the markets can be volatile, and right now they're extremely volatile. You don't want to be forced into panic selling every time your account drops by a few percentage points. And that just goes back to the point of really understanding what you're invested in, because if you don't understand what you're invested in, when the stock drops, you still don't know if it's a good deal or not. So you don't know if you should sell if it keeps going lower, unless you understand the investment. Now, when you understand the investment and the stock goes lower, you know it's a good idea to buy more. But if you don't understand the investment and it keeps going lower, then you're faced with this tough, confusing decision. Should you sell and cut your losses, or should you dollar cost average, bring your cost basis down, and buy back in at a discounted price? Historically, on average, the market drops by 10% every 2 years. And that's why you need to be prepared to weather a storm. Because if you're not prepared to lose 10% of your account value every 2 years, and that's just on average, then you shouldn't be investing in the stock market. And since 1950, the stock market has fallen by 20% 11 times, about once every 6 years. And declines of 30% have happened around 5 times. But despite all the bad news, what is the good news? Well, the good news, and the thing you always have to remember, is the best days in the stock market statistically always happen fairly soon after the worst days. That is one of the most important things you have to remember when the market is dropping. And this is a perfect example of Warren Buffett's famous quote that says, "The stock market is the vehicle that transfers wealth from the impatient to the patient." Now let's take a look back at the CNBC article that was published March 22nd, the peak of the crisis, the pandemic. Why long-term investors should never sell stocks in a panic. Now, check this out. If since 1930, an investor missed the S&P 500's 10 best days in each decade, their total return would be just 91%, instead of this staggering figure, almost 15,000%, 14,962%. So that's a 91% return for investors who missed just 10 of the best days. So this is the risk that you have when you try and time the market. The investors who patiently waited and weathered the storm made a 14,962% return just by holding since 1930. If they would have not been in the market on those 10 best days since 1930, their return would be a mere 91%. Okay, so here's another really interesting statistic. Dow's 5 worst single day point drops were in March. The index's 4 best days, all of which saw a gain of more than 1,000 points, were also in March. And a similar pattern played out in the S&P as well. So a takeaway from this is that if you don't need to sell, holding is the best strategy. And remember, the theme of this channel is 5 years or more, okay? If you are prepared to weather a storm, if you don't need this money for 3 to 5 years, the best strategy is to hold. Of course, this strategy shows the importance of not living paycheck to paycheck, because you won't have the ability to invest or weather the storm, and you won't have the ability to stay invested when the market crashes, because if there is an emergency, then you'll have to take the money out of the market, and then you risk losing out on one of the best days which weigh your returns from 90% to 15,000%. So just remember, the best days account for most of the profits that are made in the stock market. The best days account for most of the profits that are made in the stock market. Bank of America said that trading over a one-day period is only marginally better than a coin flip, while noting that the probability of losing money plummets to 0% over a 20-year time horizon. Still, retail investors try their hand, which can not only lock in losses, but also put them at risk of missing the best days. Remember that bear markets are great buying opportunities to make significant gains in a 2-year or more span. If you're not willing to make an investment for 2 or 3 years, you should just stop investing and just put the money in a savings account. Because you're not investing, because investing is a plan to grow money over a long period of time. Now let's look at this chart that shows the duration of bull markets. Let's take a look at the pullbacks of the S&P around recessions and analyze the time to recovery of each crash. So when there is a pullback in the stock market, how long does it take to recover historically? Well, the average is around 450 days. I didn't calculate that, I'm just looking at the numbers here in this article. And that's just a little over a year. So in 2001, there was a 3-year pullback. That's pretty nasty. And that's why the theme in this channel is to stay invested for 5 years or more in good companies. And remember, if you don't want to do the research on the balance sheets and the income, then you can always dollar cost average index funds, or you can dollar cost average companies that are financial safe havens. Like Google, Microsoft, Apple, etc. Now, going back to the pullbacks, this is pretty scary that the market can pull back for almost 3 years, but it can happen. So you have to be prepared to stay in. Of course, you do want to be monitoring the companies occasionally and checking on balance sheet and their cash flow. So just remember, if you're going to panic sell during a pullback, which is a very common thing to do, it's human nature, you risk losing out on huge recoveries that statistically come shortly after. And this past month, that's exactly what we've seen, this past 3 months. And you may end up in the 91% return category instead of the 15,000% return category. Of course, this all depends on picking companies with healthy balance sheets and with earnings growth year over year. It's especially important during a crisis when business income has been tarnished. If you don't have time to do the proper research, again, dollar cost average index funds and companies that are known to be financial safe havens. All right, guys, thanks for watching. Like, comment, subscribe, and I'll see you all in the next video.